Okay, next unit, consolidation procedure. Consolidation procedure ఎలా చేస్తారు? Consolidated financial statements are required to be prepared as per Ind AS 28 under equity method. An investor company has significant influence and joint control over the investee company, right? Under equity method of consolidation, no assets or liabilities of the investee is recognized. Rather, ఏం రికగ్నైజ్ చేస్తారంట, ఇన్వెస్ట్మెంట్ అకౌంట్ ఈజ్ రికగ్నైజ్డ్ ఎట్ cost plus share of investor in a post acquisition profits. What does the share of post acquisition profit? Both profit or loss and other comprehensive income in the investee. One investor company has a control over the investee, that is subsidiary company. Consolidated financial statements are required to be prepared on the reporting date as per Ind AS 110. Ind AS 110 recording consolidated financial statements only. Then what is the procedure? By combining the book value of assets and liabilities of parent with the fair value of assets and liabilities of the subsidiary. The book value, fair value of assets and liabilities of the subsidiary company will merge, plus post acquisition changes in their book value. If any post acquisition changes are there, that should be recognized. By recognizing non-controlling interest at acquisition date, value plus post-acquisition share in the total comprehensive income in the subsidiary. Non-controlling interest ఏముంది, acquisition date plus post-acquisition share in the total comprehensive income of the subsidiary. By recognizing goodwill gains from the bargain purchase, from recognizing goodwill or gains from bargain purchase at acquisition date as per Ind AS 103. By recognizing parent's share in post-acquisition profits of the subsidiary company in the consolidated and other equity. No investment account is recognized for holding shares in the subsidiary. Goodwill has to recognize gain on bargain, gain from bargain purchase at acquisition, purchase consideration. Investment account is recognized holding of the shares of the company, right? Non-controlling interest ఇవన్నీ రికగ్నైజ్ చేయాల్సి ఉంటుంది. నెక్స్ట్ యూనిట్ వచ్చేసి మెజర్మెంట్ ఆఫ్ ఫేర్ వాల్యూ ఆఫ్ నెట్ అసెట్స్, నాన్ కంట్రోలింగ్ ఇంట్రెస్ట్, గుడ్ విల్, గెయిన్ ఆన్ బార్గెన్ పర్చేస్, కన్సాలిడేటెడ్ అదర్ ఈక్విటీ. ఇవన్నీ కూడా మెజర్మెంట్ ఎట్లా చేయాలి, including measurement of investment under equity method. So Ind AS 103 states that the acquirer obtain control over the acquiree, recognizes and measures its consolidated financial statements at acquisition date. The date of purchase, on the date of acquisition only, these whatever the things will be there, measure. The identifiable assets ఏమున్నాయి, acquired, liabilities assumed at fair value, any non-controlling interest in the acquiring at a fair value or proportionate value, the goodwill acquired in the business combination or gain on bargain purchase. However, for consolidation at subsequent reporting date, the post-acquisition changes in the assets and liabilities of the subsidiary and corresponding changes in other equity, non-controlling interest of post-acquisition total comprehensive income of subsidiary should also be considered, but no change should be made to goodwill or gain on bargain purchase. At the time of acquisition of the shares in the subsidiary companies, identified assets and liabilities of S, that is subsidiaries, are recorded in the consolidated financial statements at fair value. Subsequently, the non-current items, assets and liabilities of subsidiaries are carried in a consolidated balance sheet at acquisition date. Fair value plus subsequent change in book value. However, for current items, the revaluation profits and loss on the acquisition date is reverted through post-acquisition retained earnings. Thus, the book value of the parent and subsidiaries are combined for consolidation. Suppose that unsold stock of subsidiary on acquisition date had carrying amount 1000 and fair value 1200, and after 1 year on reporting date the stock being fully sold 1300 and subsidiaries post acquisition profit should be 1000 minus 1300 300 should be reduced by 200 for consolidation, as this 200 has already been considered as what revaluation profit at time of acquisition. So in subsequent consolidated balance sheets, non-controlling interest is measured at value at acquisition as per Ind AS 103. Share of non-controlling interest in post-acquisition profits. And note that non-controlling interest as per Ind AS 103 can be measured. The parent should share in post-acquisition profits in subsidiaries added to consolidated and other entities. In subsequent consolidated balance sheets, goodwill gain on bargain purchase is recorded at acquisition date value as per Ind AS 103, that is consideration plus non-controlling interest plus fair value of the previously held interest minus fair value of the assets, net assets identified at acquisition. For finding non-controlling interest and goodwill, the fair value of the net assets can be alternatively be represented by equity plus revaluation profits and loss, share capital plus other equity plus revaluation profits losses arising from the difference between carrying amount and fair value of the net assets. Equity plus revaluation profit and loss. Net assets identified at fair value, but for consolidation on a subsequent date, the share of non-controlling interest in post-acquisition profit and loss, if the subsidiary must be added to non-controlling interest at their acquisition date. Illustration 2 suggested when dividend is declared by the subsidiary company, it appears as a deduction from the profit and loss subsidiary and as current liability in the subsidiary of the balance sheet. In the books of parent company, the dividend receivable is shown as current assets and credited to P&L. It is from post-acquisition profit or investment account. If pre-acquisition dividend is wrongly credited to parent's profit and loss, both investment account and parent's profit and loss are reduced by the share of parent in a pre-acquisition dividend. But it is important to keep in mind that this treatment is done in the separate financial statements only. When Ind AS 103 is followed, purchase consideration at acquisition date is added with a non-controlling interest. For non-controlling interest, purchase consideration will be added, and fair value of previously held equity interest and from the total fair value of the net assets identified is subtracted from finding the goodwill to be recognized. The goodwill recognized at acquisition date is not adjusted afterwards for any declaration of dividend by subsidiary, even if it is pre-acquisition profit. It is not required also, as dividend from the pre-acquisition profits are already included in the acquisition date of fair value of the net assets. It is no more required to be deducted separately from purchase consideration again. Thus, it is clear that for calculating goodwill in the consolidation of accounts, pre-acquisition dividend need not be subtracted from the investment for purchase consideration.